Welcome everyone to our year-end tax planning webinar. I like to say this is the most exciting time of the year, and not everyone may feel that way, but I think this is where all of the fun planning and all the things that we have been doing throughout the year, this is where we sort of tighten them up and really try to do things that move the needle before the year comes to a close. So welcome everyone. I hope that I don't put anyone to sleep. So we're going to try to stay animated, and as soon as Lonnie kicks in, you'll see how excited we all get about tax planning. So let's jump right in. The next slide.
All right.
You can't control the. Oh, there we go.
I'm doing the slides here.
There you go. All right. So before we jump in, just a couple of things. We're going to throw so many ideas out there with regards to year-end tax planning. One of the things I will warn is don't just go run and try to implement all of these things. It has to be customized, and one recommendation for one client may not be the same for someone else. Everyone's situation is unique. So I always recommend that if you hear something that sounds exciting, feel free to call us. I'm happy to talk tax with anyone, as is Lonnie as well. But definitely make sure that we're bringing your CPA, anyone who's involved in your planning team involved if anything that we talk about sounds exciting to you and you'd like to learn more. So I'll tell you a little bit about myself if you don't already know. So I'm Marianela Collado. Everyone calls me Nella. So I know if someone knows me, if they say Marianela, that means they don't know me. So Nella is just fine. I am the proud CEO and Senior Wealth Advisor here at Tobias Financial Advisors. I say I'm a recovering tax preparer. Anytime I get an opportunity to dive into a tax return and rip it apart and see what things we could have done differently, I will take it. And so now the fun part is I have Lonnie, where Lonnie and I can really challenge each other on tax planning and positions. So Lonnie, if you want to tell the group a little bit about yourself.
Yeah, of course. Thank you, Nella. As Nella mentioned, happy to be here. This is actually celebrating my 3rd anniversary here at Tobias, and I did start in public accounting, so I guess you can say I'm a recovering tax preparer as well, if you want to say that. But in any event, very happy to be here and use the knowledge from preparation and combine it with meaningful tax planning.
Excellent. So let's dive right in, Lonnie. This is where we go. I'll tell you a little bit more about the firm before we jump into the tax planning opportunities. So today we manage over $1 billion in assets for clients, and this is made up of IRAs, trust, brokerage accounts, you name it. It runs the gamut. Today we work with a little over 350 individual clients. I like to say that if you do the family count, it's a lot lower, because one of the things we truly enjoy doing is working with parents and their kids and their grandkids. It truly engages everyone, and the planning is a lot more holistic when you take into account everyone's situation across generations. So that's exciting for me. Today we have 8 certified financial planners on staff. So they complement all of the tax knowledge that Lonnie brings to the table. We're going to have to put a separate count on CPAs, Lonnie, right? Kind of feeling the CPA representation. Our retention rate today is 96%, which is pretty nice for our industry. And today we have a team of 25 people, and we have been around for 45 years. I still joke that we're the 45-year-old startup. So it's really exciting what we've been doing here at the firm and with the team. So with that said, now we can jump into tax planning.
Very good. And I guess you would say, so what is year-end tax planning? You know, it's not just simply putting a number into a box, but it's a holistic process, I would say, and it's different for every single client that we work on. Why is it complicated? Well, the first point there definitely comes into play this year, changing tax rules and changing compliance. Well, with one big beautiful bill, there's a lot of changes coming into play. Some things that we're going to want to take advantage of in 2025 before the changes occur in 26, and some things to think about even into next year. So um, as uh, as tax preparers and tax planners, we're constantly on our toes, and this year won't be any different. So pretty much from an overall goal perspective on tax planning is one, understanding timing. It's just so important to make sure that things get done at the right times to where you're not looking back on a missed opportunity. You're catching the opportunity while you still have time to do it. And to me, timing is the most important thing, and understanding that there's certain things that we'll discuss that have to be done by the end of the year. So on
Yeah.
January 1st, too late. So this is why we're doing this now. And it's really remarkable as we're in the process for the last 6 weeks already of doing year-end tax planning, how much of the one big beautiful bill is affecting the tax plans and changing how we might think about doing the planning.
Yeah, I love what you
Mhm.
said. And I was going to say, how beautiful do you think the bill is, Lonnie, now that you're in tax planning mode?
I mean, to be honest, this is an answer that won't exactly answer your question, but I've seen it work well for some items for clients. For example, enhanced senior deduction and maybe the SALT cap increasing. But then I've also seen it not work out. Maybe the client is over the thresholds that maybe aren't as advertised as much when people see the SALT cap went up to 40,000,
Yeah.
but there's income thresholds and you can be phased out and still only get the 10,000. So,
Yeah.
there's a lot of factors that could make it positive or negative. I guess the key is what can we do to take advantage of as much of each of these things as possible, if it is possible.
Yeah, I love that. And I think the key here is not just, you shouldn't put blinders on, right? We have to look at this from a multi-year perspective, right? So it's what's happening this year versus what's happening next year, and what things can we do to help you um, achieve a better tax result across 2 years, right? Or maybe 3 years. And I know when we run Roth conversion analysis, we're looking at lifetime, right? What is this strategy going to do for you, not just today, tomorrow, but across the rest of your life? So I'm excited to jump in. And I think that what's interesting is that I remember the general rule always being, accelerate deductions and defer income. And I think that now we're in a world where that may not necessarily be the case. So you don't always want to just default to accelerating deductions and deferring income depending on your situation. So let's jump in, and Lonnie's going to walk us through some changes for 2025.
Yeah, so just jumping right into it, income tax brackets here, and I think this is also a good time to mention for people that might be taking notes that all these slides are going to be downloadable in the materials section of the presentation, as well as this is going to be recorded, and everybody attending will be getting a copy of the recording. So no need to go crazy on taking notes on it, but yeah, on income tax brackets, as you can see, there's been some slight changes and updates. That are proposed for this next year coming up here. Right?
Yeah, so you'll see, if you can go back line
Sure.
quickly. um, Something that is very interesting is the how the single bracket is actually not too far off the married filing joint. So I guess there's a marriage penalty is what I'm seeing here, because you're jumping into the brackets what appears to be a little bit sooner. Um, if you're two household, if you have an income with two income sources, you have a household with two income earners, you're going to feel the brunt of these different tax brackets. So that's an interesting analysis. Not that I'm proposing people not get married, but it is an interesting the way the brackets are changing from tier to tier. So that's something worth exploring. And I'll also say just some housekeeping. As we go along, I tend to talk really fast, and Lonnie can talk really fast as well. If you have any questions, there is a way for you to put the question online, and I'm going to try to answer them as we go through the presentation. So don't be shy. Anything stands out to you, please go ahead and put a question in the chat, because it'll help us keep this as engaging as possible. We don't want to sit here for an hour and just talk to you. We want to engage in conversation. So feel free to enjoy the chat section.
Definitely. And I guess I'll point out while we're on here as well, we'll talk about a little later, but from somebody that goes into the 37% versus the 35%, there might be a couple of changes in the new law that actually do affect that. So we'll talk about that when we get there. All right, so moving on here, again, standard deduction amounts tweaked a little bit again for inflation and up as they usually do each year. So you'll see single and married joint, married separately, and head of household all increased a little bit here. Anything to add there, Noah?
I mean, I think the most notable thing is for everyone to realize how high these are. So if you're thinking about a typical married couple, right, who is now looking at a standard deduction of 31,000, you know, do you have mortgage interest and property taxes that would even be higher than that? So I think what we're going to start to see, Lonnie, is probably less and less people potentially itemizing, or they have to do some serious planning to be able to do that. So I think that's worth noting for everyone to pay attention, that these much higher standard deductions are going to impact your ability to take a deduction. So if you're in a cocktail party and you're bragging about how you're paying a mortgage, but it's okay because it's a tax deduction, that may not necessarily be the case. That mortgage interest may not necessarily be resulting in a real income tax benefit. So sorry,
Yeah.
sometimes we bring bad news, right, Lonnie? It's just
Yeah,
what we do sometimes.
unfortunately, yeah, we're the bearer of bad news sometimes, it's part of our jobs. But to be honest, though, I have seen that now. It really is true. Even going through the last 5 or 6 weeks deep into the tax planning, even clients a couple years ago that were easily itemizing, now they're right on the cusp of still getting standard, even though they still gave charitable contributions and maybe didn't think about front loading them, or they have a lot of interest and high property taxes, but still not enough to get over these thresholds. So we are seeing that. All right, so I'm going to move on here to the big beautiful bill. So we have the next multiple amount of slides here to go over some, I guess, high level points on the big beautiful bill and some things that could affect tax planning and could affect tax return filing next year and going into the future. So as everybody at this point, I'm sure, is aware, it was signed into law this year in 2025, and it's really expanded a lot of the provisions from the Tax Cuts and Jobs Act and added some new things as well. I would say that there's probably a piece of this bill that affects everybody in America, any taxpayer. There's probably something in here that could affect them. Again, like Noah said, some good and some unfortunately not great. But there's just a large mix of things that are occurring in this bill. So first, I know we brought it up earlier, and we'll just go right into it now on the SALT cap deduction. So part of this bill is that it raised the SALT cap to 40,000 starting in 2025, this current year that we're still in, that we still have 6 weeks left in the year. This one was not a permanent change, so there's some increases that are going to occur over the next multiple years, and then it's going to go back to the 10,000 cap in 2030 as it sits now. Now let's keep in mind, this is what we said before, is that there's a phase out, and that phase out is 500,000 in modified adjusted gross income. So as we've been doing our planning, I'm going to say that a lot in this call, we've noticed that some of our higher income taxpayer clients, even though they had well more than the 10,000, and we were excited to see that, that up to $40,000 SALT cap, they still ended up getting 10,000 because of the income limitation and the phase out that started over 500,000. So it's kind of, Nella said it in a great way. You're at a party, you're at a cocktail party, you're talking about the SALT cap. It doesn't necessarily mean it's still going to help you or not.
Yeah, and I have a couple of points to add here. When the Tax Cuts and Jobs Act, Lonnie, when that was passed back in 2017, and they put the $10,000 cap, one of the strategies for, high net worth folks was to create, multiple entities that can run up the $10,000 cap. And I remember at that time we said, well, we should also not go too crazy because all of this is supposed to sunset come 2026, right? So we told people, don't go out of your way, restructuring, creating these irrevocable trusts and doing all sorts of crazy things to try to run up a $10,000 cap for multiple taxpayers. So here we are again. Now we have a $40,000 cap that will be expiring in 2030. So I will then repeat, right? So you have to be careful. We do want to take advantage of these things and we want to try to get creative. But if we do these things and then the laws revert back to what they were, what did we really accomplish? So it's worth exploring. Like, should we do something that can help you run up a $40,000 cap across multiple taxpayers? Is it worth it? Is this something that you would have done anyway had you not been thinking about the $40,000 property tax deduction or state and local income tax for those in New York or California? And the other thing I remember, I'd done a presentation with the AICPA, Lonnie, and one of the things I did is I wanted to model this. Like, I wanted to model what the benefit would be. And what I found is that even though it appeared somebody was going to get the higher state and local tax deduction, because of the type of income they had, it actually threw them into the alternative minimum tax system. That's a word that we probably haven't talked about in ages, because effectively, to me, the Tax Cuts and Jobs Act was a way to just leave the AMT system in place, right? They got rid of state and local tax deductions. They got rid of miscellaneous itemized deductions. And what is that? That was AMT. So what I'm finding is that when someone is eligible for this higher deduction, we're seeing the AMT come back. So again, we're not bringing the best news, but for some people, it will make a difference.
Yeah, I actually saw that on a tax plan the other day now, and it was, you have to take a double look because where did this come from, right? Is this right? Is there a mistake? And you start calculating, going through, like, oh, here you go. This is why.
Forgot about AMT.
Yeah, it's
Everyone
back.
forgets. It's like what is that number?
Yeah. So, all right. So some other changes here. Again, this is an important slide here. We'll spend a little bit of time on. So on itemized deductions, again, high income taxpayers are really going to feel this. And, we mentioned earlier to take a look at that. If you go into that 37% bracket versus being in the 35% bracket. So one new change in this bill is for taxpayers that are in that 37% bracket that are itemizing, they're only going to be able to take effectively 35% of deduction on the itemized deduction. So, hey, I'm in 37%, but guess what? I'm only getting 35% in the deduction. So if that's a large number and you multiply that out, it could be a factor to think about. Also, no, I actually mentioned it on the last slide here, but miscellaneous itemized deductions, which were for the most part eliminated, are just permanently eliminated now. It's something that was temporary. Now it's a permanent change as of next year. And then again, not necessarily the best news, but a planning opportunity. Charitable contribution limitation. So again, new for this bill is starting next year in 2026 is 0.5% of AGI floor on charitable deductions.
What is that, Lonnie? What is this? When people say floor, what does that mean?
It's almost similar to what you have on deducting medical expenses, and you have a floor. So you have a certain amount that is not going to be deductible, and anything above that amount is. So as an example, if your AGI is $1 million and you donate $20,000, first $5,000 is not deductible. So you're only getting a deduction for the $15,000. And this is something that's totally separate and in addition to that 37% versus 35% cap. So our high income taxpayers are going to feel almost like a double hit on this. However, this starts in 2026. So for our clients that might be charitably inclined and thinking about doing some large donations even over the next few years, maybe a donor advice fund, which we'll touch on later in the presentation and we could talk on now, but stacking and bunching those donations in 25 might be a smart move for the future years.
Yeah, absolutely.
All right. Some other high level points here to mention. Again, starting next year is an increase in the state and gift tax exemption to 15 million. And again, this is smart to think about just dealing with the generational wealth transfer and thinking of almost like we say, you have to think 10 years into the future this year almost, or 5 years into the future. We're not just looking at next year.
And I was going to say something. You said the word permanent a few times, and I just want to qualify that word because it is permanent in that it doesn't have an expiration. But we all know that we have one of the phrases we use when we go through our investment strategy is that the only constant and the only thing that we can count on for sure is that there will be change. So what we're saying is that with this permanent bill, it is permanent until potentially there's a change in administration that decides to change the laws. What is nice about this is that the permanent part gives us the ability to sleep at night knowing that this thing is not going to fall off a cliff and we go from not having a taxable estate to potentially having a taxable estate. So this is what's nice, because if that were not the case, we would have been 10 times busier trying to get all these gifts and all these trusts set up before the end of the year. So now we don't have to rush. But what I will tell people is that just because it has been made permanent and it's going up, right? Now we're at 13 million 9, right? So say about 14 million, and it's going up to 15. What this should tell you to do is that we should do something if you're in that kind of cusp of having a taxable estate. We just don't have to rush to do it. So, and for those folks that have already done trust planning, they have room to do a little bit more. And I always encourage people that if you're already there, if you already have, you've been blessed, you have a taxable estate, go ahead and always try to maximize those gifts, because what you're doing is you're shifting the future growth of those assets. So it doesn't mean we not do anything. It just means we have time to do it. We don't have to rush.
Yeah, and just to finish on that, just with all these other things, it just starts with a conversation. Let's just talk about it and take it from there. All right, so QBI deduction, also known as qualified business income deduction, something that came out a few years ago, and it was one of those items that were supposed to sunset into 26, and now that's quote, I'll say quote unquote now, a permanent change until it gets changed again. But this is important to think about, and really just at this time of the year and in general, if you have a flow through entity such as an S corp and you're the owner and you take a salary, it's definitely an item that you should be talking to your tax preparer and just bringing it up to them and making sure that, hey, are we maximizing the qualified business income? And they can do an analysis and they can run the projections and say, hey, maybe if you actually took a higher salary, believe it or not, it would actually still save you this amount because of the extra qualified business income. It's not something to say across the board, but it is something holistically on everybody's individual situation that can be looked at and potentially could be a great planning point prior to the end of the year with payroll. This is one of those things I want to emphasize that you get to January, it's too late.
You know what I saw recently, Lonnie, actually, which I actually saw somebody draw too much salary. So to the point that, the way that calculation works, and we don't really want to put you to sleep for real. And if I go into it, I might. But the way the calculation works is you're effectively able to take a deduction, which is the lower of, because it can never be easy when you're reading the code, the lower of 20% of your net income or 50% of your wages, right? So if you took too much salary, you reduced your net income too much. And so that 20% is going to be really low. So I think there really is like a sweet spot where you get to maximize those wages for purposes of this deduction, but you don't reduce income too much. So that's something that people should pay attention to. And this one too, this is one of the same, like the cap, when this first came out under the Tax Cuts and Jobs Act, we were telling people not to go too crazy restructuring their business. But now that it's been made permanent, it may warrant a conversation, right? What are things that I could be separating from my business, that I could be, running under another entity, or really splitting different business lines. So this might be an opportunity to consider those things. I know one of the big things were pulling out real estate if you had your real estate inside your business. So these are things that you may want to explore. And really, the whole point of this, just to give people some context, is that this was a way to try to level the playing field between C corporations, right? These big corporations that we're all buying stocks of, right? All these big corporations, any C corporation in general is going to be paying a 21% tax, right? And so if you look at the way most small business owners in America operate, we're all operating under some sort of a flow through, right? We either have a partnership, we have an S corporation. And so if you operate under this flow through model and all of the income comes out to you, you're paying a tax based on your own brackets, right? So a C corp is at 21, and then you might be at 37, which is not fair, right? So how do we kind of level that playing field so that we don't all go and convert ourselves to C corp, right? Because that's a double taxation system. But the whole point of this QBI deduction was to kind of bring them to an equal footing, and the calculation kind of works out just like that too. I think if you run a C corp and then pay out the dividends, you end up in the same place as if you took a 20% deduction for the most part, and that is if you plan it correctly. So I think it's worth making sure that we're sitting down and we're looking at your P&L and we're thinking about how much bonuses or wages to continue paying out to try to maximize this.
Yep. All right, so moving on here is the new deduction that came out as part of the bill for seniors age 65 and older. And one thing, again, I could tell you in doing planning is I've actually been seeing this. I come with good news on this slide, that this has actually been helping quite a few of our clients, that what we've been seeing in the tax planning. And what's been nice is even clients that potentially might have had a little higher income this year, it was still low enough to be under these phase out thresholds. Joint, for example, 150,000, and they were getting all or even a prorated piece of this 6,000 per taxpayer deduction, and actually paying less tax than they were in the prior year. So, one thing to think about, okay, if you're not eligible for this, what are the ways that we have available, or what tools do we have available to us this year, if any, to reduce our income to get under the threshold so we can be eligible for this type of deduction and take advantage of multiple things at once. So this is, again, one thing, it's great, but do keep in mind, if you make over these thresholds, it phases out, then it's eliminated.
I'm going to add here too, and thinking about my mom, so yes, you want to do things to try to get you under, but I've also seen situations that just really just break my heart, Lonnie, like missed opportunities. So one of the things to look at, and if it's not for you, for your parent and an elderly person in your life, if all they have is Social Security income and maybe a small pension, there might be an opportunity for you to actually accelerate income. And so what could this look like? So let's say, thinking about my own parents, right? Their IRA. So now they have another $6,000 deduction on top of their standard deduction. And when I factor in maybe Social Security, the small pension, I have some room to do something. This way, a deduction doesn't go to waste, meaning that if I add in all Social Security and pension, and then that's only, say, 25,000, I'm able to deduct 37,000. I have some room to do something. So what I've done for them in the past, either go ahead and trigger gains in the portfolio because I'm not going to pay tax anyway, or do a little Roth conversion so that I can just sort of fill that deduction up and it doesn't go to waste because you're not paying tax on it. So you get to convert the pre-tax dollars into tax-free dollars, and it's not costing you anything. Eventually, if they don't use it all, it'll go down to their children, And we all know that all those rules have changed. We're not going to go into that, but it is just a smart strategy that if our parents or any person has room between the income and that standard deduction plus the senior deduction, you can do something with that gap.
Yeah, we've taken on a couple clients even recently in that exact situation, gains, in a taxable portfolio on purpose, and they didn't pay tax on the gains, but we were able to take those gains, so it was a good way to balance. So it there's sometimes presents opportunities, even if they're not right in front of you. You got to think outside the box a little bit. All right, so moving on here, I guess another positive slide in a row here for those of us that are not able to itemize deductions, but still want to have some deduction for charity. There's actually going to be starting in 2026 above the line charity deduction. And I don't know if you recall, they did this, I guess it was more than a few years ago now with much lower thresholds, but now it's $1,000 up to for a single and 2,000 for a joint filing return. So even if you don't itemize, you still might be able to take advantage of some of those charitable donations that you do during the year.
Yeah, and I will say this because I was speaking on this same topic earlier this morning, and what somebody understood in the audience was that that's a number that you can just deduct. That is not the case. You actually have to make the donation. It's not, oh, and this is a new deduction. I'm just gonna go ahead and put it here. I'm not gonna bless that.
Me either.
You actually have to make a deduction. It has to be in cash. It cannot be stock. And also, it cannot be to a donor advised fund. So just keep that in mind. It has to be to like a ultimate charitable organization,
Registered
United Way,
nonprofit, organization.
you name it. So yeah, I just want to reiterate that that's not just a number that you can just put there. You actually do have to make the donation, and make sure you have those acknowledgement letters. They're getting stricter about those acknowledgement letters. And I like to remind people, I am not the IRS. I'm not auditing you, but if you put a number on the return, you want to make sure that you have all the documentation to substantiate that in case they come knocking. This way you're not scrambling, because those acknowledgement letters have to be dated before you file the return. So let's say you don't get an acknowledgement letter and you file the return, they come and you get a nice friendly letter. If there are people at the IRS, I don't know who's at the IRS these days, nobody. But if you
Nobody.
do have, if you do happen to get a letter and it says we'd like to audit your charitable giving, which I've seen that letter and I have addressed it on behalf of our client, and they want to see all the acknowledgement letters, they're going to see that, is the date on the letter prior to you filing the return. If it's after the fact, they actually have the right to disallow it. And that would be a shame that we just lose a deduction because we didn't get, an administrative thing in our files.
Yeah, very good point. Not just for this, just for everything on the return. Like you said, if you have a number on the return, the onus of proof is on the taxpayer to be able to justify what's being used on the tax return to have an argument with the IRS.
I mean, I like arguing with the IRS, but
Yeah.
I like to have a good argument.
It used to be a little more fun when there was people there to get through to and talk to at the IRS, but we won't go into that now.
I mean, I'll never forget.
Tougher.
I'm just, hopefully you guys can enjoy this story. I'll never forget. We get this IRS letter. So I call a brand new client for me. I said, we got this IRS letter. They're going to audit you. So if you could just send me all the backup for everything you put on the Schedule C. And he says, no, I'm not going to lie. I made it all up. I said, oh my God, like, how am I going to respond to this? How am I going to respond to this letter? So yeah, don't make it that interesting for us, because that's not fun.
Agreed. All right. Moving on here, and now I'll let you touch on qualified opportunity zones for a bit. We always like to, again, if something changes in the law, we like to add it into the presentation and bring it up. This is one of those items that had a couple small changes in this bill.
Yeah, so this was a popular thing that was part of the Tax Cuts and Jobs Act. And what this does is, let's say most people know about tax deferral strategies with real estate, right? We all think of a 1031 exchange for those who might be familiar with that. That's the ability to sell a rental property and replace it with another rental property, and you get to keep kicking the can on recognizing the gain from the sale of that real estate. But with a 1031 exchange, you had to take all of the proceeds and put it into the new property. So if you sold a property A and you sold it for a million, you need to replace that property with $1 million rental property. And that's how you got a full deferral of that gain. This little bad boy is a little bit different. So the way this works is if you have a big gain, you sold NVIDIA, you sold your business, you sold, just had gains in the portfolio because we've had an incredible year in the market, whatever happens, you can take any gain. It doesn't have to be business related. It's just any gain. So let's say you sell $1 million property, your gain is 500,000. So if you take, say, $100,000 of that gain and you invest it in what they're calling a qualified opportunity zone fund, you get to defer the tax on whatever dollars you invest into this QOZ. And I want to bring it up because I want you to say, I did hear about QOZ. Nella and Lonnie did bring this up, and I know how it works. So if you take 100,000, put it into this QOZ fund, you will not be paying tax today. However, you will be paying tax in 5 years. So effectively, this is just a deferral mechanism. And if you do hold it for 5 years, they're going to forgive 10% of the gain. So you get a little bit of a carrot to hold it 5 years. They forgive 10% of the gain. Now, I'm going to just qualify this because this sounds great. Some of the issues that I see with these is that you are taking your gain, right? Let's say $500,000 gain, you take 100, you're going to reinvest it into one of these opportunity zone funds. You're investing it in a private fund, right? This is not a publicly traded stock. They are illiquid, so you're potentially locking in your money for a good 7 to 10 years. So they're illiquid. You can't just go 6 months and say, oh, I changed my mind. You're kind of locked in. And if you want out, they have to try to find a buyer that's going to buy your interest, and it may be at a discount. So you have to be aware of your ability to handle that illiquidity. I like to say you're relying on the information that these qualified fund operators are providing, right? It's not data that's readily available. This is not a publicly traded company. So I'm going to say just kind of lack of transparency. I have one, and we get reports. We're like 2 quarters behind with their reporting. So you don't know what the value is until like 2 quarters later when they're sending you the statements. So I just like to say that we don't always want the tax tail to wag the dog. We can look at this, and if your portfolio is sizable enough that it can handle a little bit of illiquidity, I'm happy to explore these with clients. I know Chad has his opinion on them. And oftentimes we're kind of digging through and making sure that if we do help you pick one, that it's one that has a lot of diversification, a good track record. So I just want to caution you, don't quickly jump on these. I think you really have to do your due diligence to understand what you're getting into, because I don't want to, of course, I don't want to pay tax, but I'd rather pay tax and make sure that I don't lose my money. So that's why I always say, don't always let the tax tail wag the dog. These require a lot of due diligence. And I'm happy to talk further about these with you if you'd like. But that's all I'll say. I don't know, Lonnie, if you want to add anything else to this.
No, I mean, really just what we've been saying on the past slides. On the surface, it might sound appetizing, but it might not necessarily be a slam dunk when you dig into it more. So it's just
Yeah,
something
and
ask before doing it. Yeah.
yeah, and
Let's
there's
talk.
one thing that people do find attractive here is that if you do hold the new investment for 10 years, the gain on that investment will be tax free. So that's something worth noting. Now, that's assuming that that new investment appreciates. You still have to pay tax on the original gain.
No guarantees on any of these things actually happening. Yeah. All right, so moving on here. So now that we've pretty much hit most of the topics, there still might be some other topics on one big bill as well. And, we're always happy to talk offline individually with clients on that. If you have any questions, please, like Noah said, reach out to us anytime. We're here to collaborate with you. But now that we've talked about some of these things with the new bill, we can go into year-end tax planning strategies that we're looking at with that bill in mind. Okay. And to start off here, we always like to talk about maximizing your retirement accounts. And you can see it on the graphic here. I won't read every single line, but you'll see what the 2025 limit is on certain accounts versus what's going to happen in 26. So two things I always like to bring up here. Number one, we still have, around 6 weeks left in 2025. So as we're doing our planning for our clients, if we're seeing that there's some room left to max out a 401k, we're bringing it up. Maybe you need to increase your contributions and do as much as you can by the end of the year. And if you do this, this is what it'll save you. And we break that down. So it's something to think about. But then also for 2026, what we've seen a lot during planning is a lot of times the increase in these thresholds are not necessarily conveyed into what you're taking out in your paychecks. So by the time you get through 2026 and we come to this time, it's short again because that extra $1,000 increase on a 401k wasn't brought in. So now's the time to do this, not only to max out 2025, but also get 26 set on the right foot.
Yeah, so I just want to say, how do you do this? So it's very simple, very, very simple. Don't get stressed. And I know taxes tends to intimidate a lot of people. All you need to do is look at your most recent pay stub. Okay, so you look at your most recent pay stub and see year to date, what have I contributed to my 401k? And if you're seeing that you're at 15,000, well, we just told you you can go up to 23. So see how feasible, cash flow permitting. Obviously, we have to eat. So you need to keep a roof over your head. But if there's room, how much can you contribute in the next few pay periods to get you as close as the 23,000 as you can? And sometimes when I'll ask people, "Oh, are you maximizing your 401k?" They'll say, "Yeah, yeah, I'm doing the maximum." And what they're understanding is that they're doing the maximum to get the match. That's not what we mean by maximum. So you should absolutely do the amount that gets you the match because that's, free money, the way I call it, free money. But maximizing is getting to the full 23,500. And also take a look. If you're doing traditional versus Roth 401k, that's going to have an impact on your tax return. So if you're close to all of these thresholds that we have been talking about, like let's say after your wages, income, you're at 515,000 of income. Oh my God, you went over by 15,000. So now you're going to get phased out from the state and local tax cap. So perhaps you can fix that by maximizing the 401k contribution. So there's so much opportunity. So don't lose the opportunity to look at that pay stub, the latest one, and then kind of see what all the year-to-date numbers look like and see what adjustments you can make, right? Is that the best way, Lonnie? Just kind of helping them, or call us. Obviously, we'd be happy to help you understand your pay stub. Because sometimes that pay stub, depending on where people are working, it has so many lines, and people don't know what's taxable, not taxable. But what are your
Yeah,
thoughts?
no, 100%. And that's the thing. Pay stubs can get tricky. There's a couple of standardized payroll companies out there that do most employers, but then there's probably 50% of them that have internal payrolls. And the payrolls, the pay stub might be 4 pages long with all sorts of weird looking deductions and stuff. And I think the best thing you could do if you're not sure is just send me an email, send anybody on the team an email, give us a phone call, and we'll look at it. And again, for our clients that we're doing our tax planning on, this is something we're looking at, not only just for 401k, but also, do they have an HSA plan at work? They do. Okay. Are they maxing it out? No. What is left? And this is kind of the holistic type of process we go through on every client. And it extends more than just through the employer, but sometimes you might have self-employed income and there's a traditional IRA contribution, or maybe your income is over a certain threshold, but we could do a backdoor Roth conversion, which we'll talk about later on here. So I guess where I'm getting at here is don't memorize this slide, but understand there's so many opportunities available, and some of them can combine with each other to maximize your tax situation. All right, so, oh, look at that. There you go, Roth conversions. So Roth conversions, and I only had to pay tax on one seat. I love the picture here. So a lot of times there's two things to think about with Roth conversions, I'd say, okay? First off, if you're going to do a Roth conversion, it's something separate or different than doing a backdoor Roth contribution. I think that's important to notate first. For certain clients that are over income thresholds, you might have to do a non-deductible IRA contribution and then convert that to Roth, which you'd be converting it tax-free because it was a non-deductible contribution. But then in other situations, and we do this in our planning, is we'll run scenarios. Okay, well, what if you convert $10,000 from your traditional IRA to Roth? Not a backdoor Roth conversion, but just converting it over directly. And a lot of times, again, depending on the overall tax plan, sometimes we could do that tax-free. Sometimes it's such a minimal tax that it's worth it to get into a Roth account. And again, we really are big fans of Roth accounts for most of our clients, given that once that money is in that Roth account, it's growing tax-free and it can be taken out tax-free.
Yeah, this always makes me think of I had a client, and I said, oh, what kind of tax planning are we doing for your dad who was in his 90s? And she goes, oh, we don't pay any tax. And I said, oh, that's interesting. She said, yeah, he's got kind of round the clock care, and so his medical expenses, all in, it's like $150,000 between the round the clock aid, actual hospital, doctors, you name it. So he had this huge deduction. And so his income, there was a lot of like tax exempt and Social Security. So he basically had what looked like a loss, right? So his income was like 75, and then we had like $150,000 itemized deductions. So it was negative. Taxable income was zero. And I said, oh my God, this is, again, as I had mentioned, with the senior deduction, that's just, a lost opportunity. That's an opportunity to get rid of IRAs and do these Roth conversions to fill that gap, because it's not costing you anything. Because that deduction, that excess deduction, unlike a business loss, right? It's not carrying over. So either you use it, or you lose it, right? So one way to use it and make the most out of it would be through these Roth conversions.
But in the current year, for what we're talking about here, like January 1st, if we found out that you could have done 75,000 conversion for free, it's too late. So that's the important note here.
Unless someone has a time machine, and then we can make it happen. But
if that's the case, let us know, because we
let me know. Call me, please. I will.
But yeah, this is important. And, in our tax planning, even in our software, we have range calcs and other tools that we use that can actually see what is the maximum dollar that you can convert before you go into the next tax bracket. So this can, again, very holistic. You hear us say it a lot, but on a case-by-case basis, we really analyze this for clients. All right, so moving on here. We talked about this a little bit at the beginning, and being cognizant of the changes that are going to be effective in 26 for charitable giving. But one strategy that we always like to emphasize is donor advised funds and bunching of charitable donations. And again, a lot of times this is an appreciated security that you're donating into a donor advised fund that is pretty much saving you paying capital gains tax on that security, and you're gaining the tax deduction on the donation. So now more than ever in 2025, before these new thresholds kick in next year, anybody that might be charitably inclined, this is something to think about this year.
Yeah, if you're giving, I mean, even something, you know what, all in, Nella and Lonnie, I give about $1,000 a year. Well, if you're doing that, maybe if you're not itemizing, you're going to get that above the line, which is all well and good. But if you're giving 5,000, now you know that you're not going to be able to itemize, and maybe you get one above the line. Well, this is like the perfect parking spot for us to maybe look at the next 10 years and bring them all into this year and do it all at once, but put it in your little charitable parking spot. Then you can brag that you have the, Collado charitable family charitable fund. But this is nice because it also gives you an opportunity to have conversations with your children about philanthropy, if that's something that is interesting to you. I think it's just a great tool. You can put the money in there, and then you don't have to distribute it. You distribute it at your leisure. It does have to go to ultimate 501c3 organizations, schools, religious organizations, any charity of your choice. So it's a great opportunity. These do have a deadline. If you don't already have one, they have to be set up at Schwab by December 5th, I think is our cutoff. So what I've been doing is that if anyone has shown an interest in possibly setting one up, I'm just setting it up, and then we'll figure out if we're going to fund it before end of year.
Yeah, you hit the nail on the head. You actually took the words right out of my mouth just on the time constraints, because even though the end of the year might be the date for the donation, this has to be set up well in advance and thought about well in advance. So really, within the next week or two, we should be figuring out if this is going to happen or not for this year for it to occur. And again, like I mentioned in the last slide here, and again, everybody will have these slides so you can read through and see the savings and the value of donating an appreciated security through doing it this way versus just a cash donation. But really, because you're saving on the capital gain tax that you would have paid before, there's a higher tax savings by donating the appreciated security.
Yeah, and what I'll say is like, I have someone they had bought Facebook like really early on, and he wanted to make a pretty sizable gift to his donor advised fund, and he was going to do it in cash. I said, no, let's go through your portfolio, see what you have in there, and if this is the play account, we kind of go in, we go into the play account, and there's this one security, and it's just gone, significantly up in value. It's got so much gain. So out of the total value, like 90% of it is all gain. So, and he loves that position. So I said, all right, how about we do this? Go ahead and donate it so that you don't have to pay capital gains on all that appreciation. And then the 50,000 that you were going to donate anyway, we can just buy the stock back. When you do that, there is no such thing as a wash sale, which you have probably heard. That all relates to taking losses, but you can donate and buy right back, and you're in the same place, but you got rid of a tax burden. So it's really smart to do your charitable gifts this way.
All right, moving on, just in the essence of time here for the presentation. So again, we already kind of talked about gain harvesting earlier, where maybe it makes sense to take a gain without it costing you any tax, or maybe a small tax that is worthwhile. But also loss harvesting is something that our team does throughout the year, and we look at it at year end again. And it's just important for us to do this and have a parking spot for losses to maybe help you in a future year when you sell a business or have a capital gain in a future year. And it's perplexing to Nella and I and the whole team where we've heard other professionals tell us that it doesn't make sense to do this. It makes full sense to do this when it's available.
Yeah, and I think sometimes it's just confusion, right? So
yeah.
we still believe in being a disciplined investor, and this has nothing to do with trying to, time markets or get out if the market has gone down in value. That's not what we're trying to do. If you invest $1 today and there's a market downturn, we know that it's going to cycle back, right? That's what we talk about all the time. But it doesn't mean you should fall asleep at the wheel. All you're doing is on that dip, you're just making magical tax losses. And then you're going right back in the market, obviously not using the same exact security, because that would trigger wash sales and the IRS would disallow it. But we know that you're going to come right back with the recovery, but you were able to just generate a magical tax loss that if you had just gone down and recovered, you'd be in the same place, except you didn't have the loss for tax purposes. And we all know that any dollar you save today, you're basically keeping it on your side of the balance sheet, not with Uncle Sam, and you're growing and you're using it to grow your wealth. So it's not about not having gains or growth. It's just you want to take advantage of all market cycles.
Yeah, and real life scenario real quick on this. We just had it on a tax plan where a client in 2025 needed to take out a large trigger a large gain in their taxable portfolio. They needed the money out to do some home repairs and some other things. And because of the active loss harvesting over the last few years, they paid no tax on that money that they took out because they had these carryover losses. So
Yeah,
it's a huge thing.
we actually did something, a really interesting analysis for a client that had a whole like CD ladder. And this was a whole collaboration between tax and portfolio, kind of figuring out if there was opportunity to actually sell those CDs and convert what would have been ordinary income into capital gains. And this client in particular, we did all this loss harvesting. So basically, income that would have been ordinary interest income converted to capital gain, and then we have all these losses. So we're going to get the same income, but he's not going to pay tax. It's just like genius strategy. So if you have any questions on that, we can talk loss harvesting all day. We love to do it.
Yeah. All right. So moving on here, I won't spend too much time on the health savings account, but we did talk about on the last slide. And again, I guess a couple notes. You have to have an eligible plan with your employer. That's a high deductible plan. And when you do, you have this opportunity of opening potentially a health savings account. And sometimes employers actually contribute a portion of this, which is just like if you have a match on your 401k, it's a free benefit you don't want to lose. And what we really love about these accounts is not only do you get a deduction for contributing in these amounts, then the money grows tax free, and eventually, for the most part, as long as you keep good track of all your healthcare expenses over the years, a majority of it you can even take out tax free. So it's like a triple crown, this account.
I call it the triple crown, but yeah. I don't know how much we're going to get through. If we don't get through all the tips, because we are coming up on about 3 minutes, please, if there's anything that piqued your interest, feel free to call. I'm not sure we're going to get through all of them, but we'll see how quickly Lonnie and I can talk. But if we don't get through it, and there's anything on top of mind for you, any questions, feel free to reach out.
Yeah, we thought it was important to start with one big bill on this presentation, just given that it affects so many of these strategies. So I'm going to kind of skip through here. This is something at least to point out for a lot of our clients that affects the qualified charitable distribution. And pretty much in essence, as it says here, you're donating directly from your IRA to the charity. And again, this is important. Like Nella mentioned earlier, those standard deductions keep going up. Well, this is something you can still take an above the line deduction on, even if you can't take itemized deductions. So we have a lot of our clients that charitably incline and do this. They satisfy an R&D requirement and donate it to charity and get a deduction. So again, here we talked about before, I won't go into it much, but utilizing these retirement accounts, even if you have self-employed income, a Schedule C or such. So again, we could talk offline if anybody has questions on that.
Just because you don't work for a big company that has a 401k doesn't mean you can't set up your own 401k. And if you don't have employees, solo 401k is such a great tool. We don't need to get all crazy and get expensive pension plans in place. Like, this is low-hanging fruit. If you have consulting income, any Schedule C type income, you can do this.
Yeah, and whereas the account might need to be set up, you don't actually have to contribute that until you file the tax return with extension. So again, it's another thing. Let's make sure the account is set up, but then we can worry about it when you have finalized figures after the end of the year.
Yeah.
I don't know if we want to spend a lot of time on this, given that we talked about the change to 15 million on the estate level here and annual.
Yeah, I'll just remind people, if you're paying for anybody's school or medical expenses, pay those directly so that they don't count as a gift. And then if you are funding 529 plans, I always like to look at the opportunity to accelerate those gifts and kind of get it all in there at once. So any questions on gifting, let us know. We'd be happy to walk you through all the mechanics of that.
Yes. Stock options, again, this doesn't affect a lot of our clients. It does affect quite a few of them. And, you know, if you do have stock options, please let's talk about it, because this could greatly affect tax planning and your tax return. Again, I think we're gonna have to push through some of these, Nella, here, given the time here, but tax efficient investing, I think, is something that, you know, you talk about holistically with each of our clients. And questions, so we did get through it.
Oh, that was impressive. We kind of sped through some of them.
Yes.
If there's anything that you want to learn a little bit more about, please don't be shy. We are right up on the hour. It's 1:30. I want to thank you all for spending this hour with us, and hopefully you learned a thing or two. And if you have any questions, you want to talk with anybody from our team, please feel free to reach out, and have a wonderful afternoon. Thank you all.
Thank you. Thanks, everybody.